We are joined now by Brian Singer. He is the head of energy equities for Goldman Sachs. This is really, in many ways, your conference. So thank you for having CNBC here exclusively as the broadcast partner. We appreciate
my pleasure. Pleasure to be here.
Okay, so before we get into some of your picks, you've got just 2 names on your conviction buy list. I know the traders have questions as well. Day one, keynotes. We spoke to CEOs. You've talked to them publicly, privately. What would you say are the 1 or 2 big themes / takeaways of today?
Look, I think this is a scenario where right now oil prices are much higher today relative to where both the companies and investors thought they would be just a month ago. And so one of the big issues that we're facing at the conference is, are we seeing producer discipline among the shale producers? Are we going to see producers begin to increase activity, or are they going to use the incremental free cash flow or cash flow from oil prices for free cash flow to return to shareholders? And the bottom line is, the message that we're hearing across our panels and from managements is that discipline is holding, which I think is going to help improve energy equity sentiment.
Yeah, I think most of these companies seem to have 50 to 55 as sort of their benchmark on their balance sheet. You know, Guy Adami, the most amazing thing that we heard today, and we had a lot of interviews, came from Chevron. I asked Michael Worth, I said, for every $1 that the price of Brent crude goes up, approximately how much does that add to your cash flow? $450 million a year, something like that. I mean, the numbers for just an incremental dollar are staggering. Does this then, at 68 on Brent, 63 on WTI, just really add to a story that's been tough the last few years? Yeah,
look, I think there are a number of higher quality producers like an EOG and a Chevron where we think their incremental cash flows can be very significant. EOG is one of the stocks that we like. They are super levered to the higher oil prices, among others. And one of the reasons that we like them is you don't have to believe in oil prices of today. We think that even in a $60 to $65 type Brent oil world, they can get mid-teens production growth, double-digit corporate returns, and still have low to mid-single-digit free cash flow yield. So there's really a lot that they can do.
Get the traders in here in a second, but there's 2 names that you have on your conviction buy. You have some buys, but your conviction buy list, you've got 2 names, and that is EOG and Pioneer Natural Resources, PXD, which is interesting because those are the 2 companies I hear often among the mid-majors that I talk people say those are the best management teams in the business, Bill Thomas and Scott Sheffield. Now, earlier today, we spoke with Scott Sheffield. The interview will air tomorrow morning on Worldwide Exchange. Scott, who, by the way, spent much of his childhood in Iran, his dad worked for an oil company, thought the escalations would increase, and he is calling for $10 to $15 higher prices for oil. Listen to this and then have you respond.
We'll probably see a higher price. We're probably going to see another $10, $15 on top of where it is now. So I'm probably more optimistic. There's no extra supply in the world. The U.S. is no longer that supply like they have been the last several years. And so we're going to see a higher price for the price of oil.
All right, so Brian, if Scott Sheffield is right and prices go up another 10 or 15, what happens to these equities?
Well, look, if it's a sustainable increase in price, then you have a lot of equities that are going to move higher because the equity sentiment today is not reflecting the prices of today, let alone $10 to $15 higher on a sustainable basis. But the bottom line is our base case view is we don't think that this is an all hands on deck moment for shale producers. We think that really we don't need every company's balance sheet to be restored. We don't think every company needs to grow aggressively. So it's really the companies that are low on the cost curve, like a Pioneer, doesn't need the higher oil prices, $10 to $15 higher from here, can grow 15%, can have mid-double digit or can have teens type corporate returns and still have free cash flow like EOG.
Guy Adami, Mr. Goldman, get in here.
Brian Singer, thanks for being here. Brian Sullivan, in the Would You Rather game, we would rather be in Florida. That's a different game. But, Brian, my question to you is, EOG got cut in half from October 2018 till this October, 130 to 65. The stock has had a pretty significant move. If crude were to go sideways for the next month and a half, is this a stock that can still accelerate, in your opinion?
Yeah, we think it can because we think we're in a bottoming phase for energy equities. And it's driven by 2 factors that we have not seen over the last year to 2 years. Number one, we think from a micro perspective, free cash flow yields are improving and are a lot more competitive with the S&P 500 as are corporate returns. And EOG is a leader in both of those. Second, we think we're moving to a period post-2020 where we no longer need OPEC to need to lower production. We actually may need OPEC to need to raise production. And so that has the potential, without an increase in oil prices from here, to improve energy equity sentiment for the high-quality companies, and we think that can reverse some of the middling performance of EOG.
Tim?
Hey, Brian Singer, thanks for joining us, and congrats on what I hear has been a great conference down there. EOG, which you like, perversely, some of the criticism around this company is that they're actually not levering their balance sheet more. I mean, they've talked about some urgency, or there's been some sense that they wanted to buy back shares, that they actually wanted to do stuff to increase kind of the earnings leverage in the company. Can you talk about that? Because that seems rather contrary to a sector that's been laden with debt and companies that have been making, poor allocations of capital.
Yeah, and I would agree with the assessment as it relates to a lot of the other companies. But we think that companies that can prove that they are low on the cost curve using 10Ks and 10Qs, that have good corporate level returns, that have free cash flow, and by growing do not sacrifice their advantage in any of the above, should have the opportunity and the right to grow. There aren't very many companies in that mix, but EOG, we think, is one of them. Now, this year, particularly if prices hold at these levels or higher, then there actually may be an opportunity for EOG to do more than that and buy back some stock.
All right, Brian Singer, we're going to let you go. Thank you very much, Head of Energy Equities. Thanks. We'll let you get back to your conference.
Great.
I think it's the cocktail party time of the night. We're invited. We'll go after the show's over.
Happy to see you.
Brian, thank you very much. Appreciate that.
Thank you very much.
It's interesting, guys. We're talking about Pioneer, and we had Scott Sheffield on. We're looking at numbers, and everybody always wanted to know what's the break-even cost. I think what's amazing, Jeff Mills or Karen, about Pioneer is their break-even cost is $20 a barrel, maybe $21 a barrel. They've got the best acreage, the lowest costs, and by the way, their net debt to EBITDA ratio, 0.3%, when half the industry is trading at more than 2 times net debt to EBITDA. Not all oil and gas balance sheets are created the same.
No, and I think these are the kind of names you want to play. Thinking about EOG as an example, they have a low cost structure. They source their own fracking material. They do their own prospecting. If you look at free cash flow yield, it's 4 to 5%. So I think those are the names you want to be in when the price of oil is uncertain. We don't know if it's going to go up or down from here. So I think being in those names that aren't levered to materially higher oil prices and have that lower cost structure, I think that's where I would want to be right now.
I agree. I think the risk reward is compelling when you have a low cost operator if the prices trade down. But also, as the whole space moves up, it'll attract more money. And where are they going to go first? They'll go to quality. And so you're going to be better on an upside there, too, in an EOG or Pioneer.